Welcome to Security Token Stories, brought to you by Security Token Academy, the leading educational platform dedicated to covering and facilitating the security token industry. I'm Derek Edward Schloss, Director of Strategy at Security Token Academy. Coming up on today's episode, we have Stephen McKeon, partner at Collaborative Fund. Collaborative is a San Francisco and New York-based venture fund investing in blockchain-based financial infrastructure with an eye towards the future of our financial markets. Steve is also a finance professor at the University of Oregon, a good friend of mine, and one of the sharpest thinkers in the security token space. As many of you who listen to the show know, I've had Stephen on before in one of the first episodes on the podcast. It's a can't miss episode. We talked about his security token thesis paper and how for many traditional assets, security tokens will simply dominate previous methods of reporting and trading ownership through a number of killer features that security tokens and distributed ledgers enable. The episode today with Steve builds on that conversation. We take a look back at the security token industry in 2019, trends that Collaborative Fund is seeing in the decentralized finance and DAO spaces, and how all of these areas of interest may intersect with security tokens and traditional finance in 2020 and beyond. A note before we jump into the episode, in addition to reminding our listeners to carefully read the disclaimer info on our website at securitytokenacademy.com, I'd like to quickly mention that the law as it relates to blockchain-based instruments and assets is still a work in progress by regulators and legislators around the world. STA considers the information to be provided in this podcast to be of interest to our listeners, but we make no representation as to how or whether any assets or projects discussed on the podcast fit into any regulatory system. The information discussed in this podcast is purely educational and not investment advice. And one final note, as we roll into 2020, I want to say thank you. Our listenership at Security Token Stories has really grown over the last few months, and our team is grateful for all the feedback, comments, and emails we've received on our first 12 episodes. On behalf of the STA team, thanks for making this such a fun journey for us so far. As you listen to the episode today, we'd be grateful if you could take 30 seconds, leave us a 5-star review wherever you're listening to the podcast, and share the episode out with your friends and professional network after the episode. Make sure to tag Security Token Academy, and we'll make sure to say thanks. Now, on to this episode of Security Token Stories. Steve, welcome back to Security Token Stories.
Thanks for having me, Derek.
Absolutely. I think this episode is going to be a really fun one for our Security Token Stories listeners. You and I have had a chance to speak fairly frequently this year on the industry's evolution, along with some of the greater blockchain trends happening that are informing some of the early financial projects building out in the space. There's a lot of cool stuff happening as we roll into 2020, and you have a unique lens given your role investing at Collaborative Fund. We're going to talk about a few different themes and areas today. We'll start with the overall traction in the security token space, then kind of move into your work specifically at Collaborative, trends you're seeing in the DeFi and DAO spaces, and then finally recapping your year at Collaborative and looking out to 2020. How does that sound?
Sounds great. Thanks.
Awesome. So let's kick off the episode with a question about institutional traction and security tokens. You know, a few weeks ago, the Bank of China issued $2.8 billion in bonds using a self-developed blockchain-based system. Earlier this quarter, HSBC, one of the largest banks in the world, announced it would digitize $20 billion in private placement securities and put them inside of a new blockchain-based platform over the next couple of months. In Q4, and this one's one of my favorites, the Paxos team in New York received an SEC no action letter to work with Credit Suisse and Societe Generale on a pilot blockchain settlement project outside of the NSC's legacy securities clearing system. Now, Steve, I bring up these projects, which were all, recently announced, because it feels like we're starting to see some of the largest financial institutions in the world make investments directly into the security token space. And there's others like Santander and Japan's SBI Group. Does this institutional traction align with what you're seeing at Collaborative? Are financial institutions poised to have more of an impact on the industry in 2020 and beyond? I guess, how is your team thinking about the role that these institutions are playing in the security token space?
Yeah, so I think that they definitely are going to be increasingly visible in 2020. I think many of these groups have actually been working on the space for some time, even predating 2019, but we've seen more of a public-facing stance from them in 2019 as the space has continued to, rise in prominence and get more traction. I mean, I think at this point, virtually every major financial institution that we've spoken to is looking into this and is at, some stage of the journey. So you've got institutions like Fidelity that are out front. You've got multiple entities or kind of groups within Fidelity that are working on different initiatives. They've, of course, been very public about their interest in the space and support for the space for a long time. But you've got lots of others like MUFG, which is like the fifth largest bank in the world. You've got Barclays, Wisdom Tree, Goldman, all doing deep dives, either with pilots or at various stages. A lot of these are kind of within their innovation groups. And I think the one thing we've definitely seen is just how long it takes to put anything into production at these major financial institutions, right? And so I think that's, you and I were talking a while back, and I was saying that, kind of in jest, sort of how, rewiring the global financial system doesn't happen overnight.
Yeah, it's one of my favorite quotes of the last year.
And it's true, right? I mean, you talk to the folks in the bank; they're very excited about it. I think they all see that financial market infrastructure is evolving. They want to make sure it doesn't pass them by. That said, to get this through the risk management departments and all the various sort of people that have to sign off to actually go live with live securities inside an institutional environment is a really big lift. And so I think we're going to continue to see more announcements in 2020 and more things going live, but we might see it get traction outside the US first. So you mentioned Societe Generale, the action in China, Santander. There's a lot of entities outside the US that operate in different regulatory environments where you might see a little bit more swift action in terms of actually bringing live products on chain.
Yeah, that's great color. Steve, speaking to the regulatory side of security tokens for a minute, this is something you and I have been tracking closely for the last year. I think things really started to pick up with the investment contract framework from the SEC, back in April. I think one of the bigger pieces of news happened this month when the SEC announced a new proposal to expand the accredited investor definition in the United States. And as you know, and as many of the listeners will know, the accredited investor definition plays a fairly large role today in determining who may participate in our private capital markets. And expanding that definition may have significant implications on securities fundraising and kind of by extension, security tokens. So, it could open up private market investing to a far greater number of participants, which I think runs in parallel with a lot of the hopes for the democratization of finance and these ideas around finding more involvement from wider groups of the population in the future. So, Steve, as it relates to our private markets, assuming this definition is expanded, have you given any thought on how important this expansion might be alongside this kind of grand trend line of more open markets, digitized finance, and blockchain-based securities?
I think it's really important, and it's something that we've been advocating for years in terms of an expansion of this definition. The wealth test, I mean, the nice thing about it is it's very objective, right? You can, you've got a quantitative line in the sand where if you exceed it, then you're credited, and if you don't, you're not. The problem is that it doesn't actually map really cleanly to who has actual knowledge that can, facilitate an informed investment decision. You've certainly got a lot of folks with wealth that may not have a lot of experience around securities and investments. You've got other folks with a lot of experience around securities and investments that maybe don't cross the threshold in terms of income or the wealth test. And so I think it's something that is really overdue, frankly, for being addressed. I'm really excited to see the SEC address it. I think, if you look around the world, a lot of other areas in the world, the EU being one, does have more of a knowledge-based test. And it looks like that's what we're going to have here in the US. Now, the Jobs Act helped, right? So the Jobs Act created, through Reg CF, the ability for unaccredited investors to participate in private markets. The problem is it created a bit of a lemons problem where a lot of, basically, if you could get institutional capital, you went that route. And then a lot of the entities that used Reg CF were those that couldn't get institutional capital. The other problem is the cap was very low. So if you're trying to raise a substantial amount of money to really build something big, the Reg CF wasn't going to work for you. So I think this stands to really expand who can participate in capital markets. As you said, the devil is going to be in the details in terms of exactly what the tests look like, whether it's some sort of credential from an educational institution and what that looks like. Like, is it a finance degree? Is it any type of business degree? Does the institution need to be accredited? So on and so forth. So I'm looking forward to seeing the details. But if you just look across the wealth that's been created in private markets over the last decade, with companies that are staying private longer than ever, right? Whether it was Uber, Airbnb, many, many others, you saw get to a very, very late stage before they considered going public, where the average person could participate. Some of those, of course, haven't even gone public yet. So much wealth was created in private markets. It would be great for everybody to be able to participate in that. Now, one thing I should mention is it is more democratized than a lot of people give it credit for, in the sense that if you look at a lot of the large investors to venture capital funds, there are things like pensions. Well, what is a pension? A pension is basically a pool of capital from individuals. And so even though I may not have direct access to buy shares in Uber when they were private, perhaps to the extent that my retirement plan is managed by a pension that invested in a VC firm that invested in Uber, individuals do have some exposure to these private companies. But I think the change in accredited investor laws will make it more direct.
Yeah, I think that's a great point that you brought up there at the end. And something I tend to think about a lot is this idea of equality, not so much equality of outcome, but equality of opportunity. And so I agree with the point you brought up about pensions. I also think that finding more ways to spread the opportunity to invest in these early stage entities, especially as a lot of the value now is being captured pre-public markets. I think that that equality of opportunity will hopefully kind of lay the base for what we all kind of hope these markets can do for us in the future, and for many individuals who aren't able to participate today. Steve, let's bridge over to some of the general blockchain-based finance traction that you're thinking about at Collaborative. We can get into DeFi and DAOs, a lot of the stuff that you and I have spent a lot of time talking about over coffee over the last year, and how some of this stuff might inform security tokens in the future. But before we jump into the specifics, I think it'd be great for our listeners to hear a bit more about Collaborative Fund. At a high level, what is Collaborative Fund's thesis as we roll into 2020? Has that thesis changed after watching 2019 play out? I guess, how is your team thinking about the space as we roll into 2020?
Sure. And maybe it makes sense to just take a quick step back and provide some historical context on Collaborative, because as many of your listeners probably know, Collaborative has been around for about a decade. And so definitely predates investments in crypto. And so the genesis really was that decentralization is really in Collaborative's DNA. So the thesis has always been around things that are making the world better and are also going to generate outsized returns. And if you look through the investments historically, a lot of those have been sort of disintermediation through tech. And so the extension to crypto, I should say, was really a natural extension of the thesis. And so that hasn't changed. The opportunity we've seen around crypto is particularly within decentralization of financial infrastructure. And so things like proliferation of wallets, one of the things we mentioned in our opening announcement was this idea that, someday everyone will have a digital wallet the way everyone has an email address today. It'll be uncommon to meet somebody without a digital wallet. We still believe that to be true. And so I think we're still excited about what we're seeing in DeFi. We're excited about what we're seeing in terms of the merging of crypto infrastructure and traditional infrastructure. And so I'm really looking forward to 2020. I would say outside of that core focus around financial infrastructure, we also see an opportunity in gaming. So gaming is a gigantic industry. If you look at just the size of the market for video games, I believe I read the other day that it's larger than most other media types combined, right? So if you add up movies and television and magazines and so on, that the market for video games actually in aggregate surpasses all of those combined. And we've always felt like crypto and gaming is a natural fit. We recently invested in an early stage company called Zebedee. Zebedee's basically extending the Lightning Network to gaming to make it really easy for developers to integrate Bitcoin via the Lightning Network into game environments. And so that would be considered non-core. It's not directly financial infrastructure, although it is facilitating payments in a sense. And so that's another area that we're excited about.
Steve, diving into kind of some of the specifics on financial infrastructure, one of the areas that seemed to pick up traction this year was DeFi and open finance. And there's leaderboards, there's a number of projects that have really started tailoring their protocols to fit into this space. And there's also a number of projects operating in the space that may have implications on the security token industry, in addition to kind of this overall trend line towards the digitization of finance. Can we walk through a quick background on a few of the popular projects, how they work, why you're excited about their early potential, and how these protocols might implicate blockchain-based securities in the future, whether it's something like credit facilities for security tokens or burn tokens and revenue share tokens that are acting securities like? Maybe we can start with projects like Maker and Synthetics.
Yeah, absolutely. So Maker, it's posted on our website, is a project we have exposure to. We've always viewed Maker as being one of the central actors in DeFi, primarily because the system emits DAI, which is effectively a stablecoin, decentralized stablecoin that is backed by other crypto assets. So historically, it's been Ether, right? So you deposit Ether, you receive DAI. And what we've seen in 2019 is an expansion to multi-collateral. And this is really, really important. And it's something that I think everyone who's been involved in the Maker ecosystem has been looking forward to for a long time. And it's directly relevant to tokenized securities. So the idea is that now, instead of just Ether, you'll be able to deposit a variety of other assets, which we expect that set to expand over time. And it could be anything from, tokens that represent interest in real estate or various types of fixed income like auto loans. It'll be other types of crypto assets. And what this allows you to do is effectively generate almost instantaneous leverage without any type of credit decision, because you're depositing collateral. And so we continue to see Maker as one of the most important projects in the space.
Yeah, that's great. Are there any other projects you find interesting right now in the DeFi open finance space that may or may not implicate security tokens in the future, but are really starting to gain traction in 2020 that you think more and more eyeballs will start to kind of turn towards as kind of the project picks up steam?
Yeah, there's a few. I think you mentioned Synthetics. I think that's a really interesting project. So just at a high level, users can basically use the native token to Synthetics to create basically derivative assets. And so this could be a stable coin, it could be a asset that tracks gold, or various others. And we're seeing more activity around this type of idea. You got other projects like UMA, Universal Market Access. You've got Open, OPYN. And the basic idea is that these systems are very flexible, and we can use sort of a backing token to create other, basically exposure to other types of derivatives. And so I think this is a side of the space that really started to get traction in 2019, but we're going to see a lot more of in 2020. So that's definitely a space we're looking at carefully. Another project I find really interesting personally is Melon. So Melon's been around for a little while, basically automating fund management. We think this is going to be really important for Web3. And What's interesting about Melon is they basically they developed it and then turned it over to a DAO in terms of governance. And so maybe we can chat about DAOs a little bit more in a minute. Also interested in a project called Amun, AMUN, basically taking crypto assets, bringing them to traditional markets. So they're creating exchange-traded products in Switzerland and soon the EU and other places, sort of sitting right at that intersection between traditional infrastructure and crypto infrastructure. And then I think finally is just this idea of the rise of sort of revenue share tokens. So whether that's Block's route, which is a layer zero network, is sort of speeding up and creating scalability within Ethereum, or various exchange coins. We've seen Binance, Bitfinex, Poloniex. I'm sure we'll see others. And this idea, if you look historically at the way securities work, right? So typically, when you think about a share of equity, that gives you a claim on the bottom line. So if you think about it like a financial statement, right? So the company generates revenue, it has expenses, and then investors have a share of whatever cash flow is generated, which roughly correlates to profits. And what we're seeing now are assets that are taking a portion of the top line, right? So the idea is that the entity issues some tokens that represent all the revenue that is going to be generated, and then if they sell, say, 10% of it, then the investor, the holder of those tokens, gets 10% of the top line, 10% of the revenue, and the project gets the other 90% to do, cover expenses and do whatever else they need to do. This changes the dynamics of the way you think about governance and the way you think about value accrual and incentives. So it's something I'm thinking more about, and I think we'll focus on a lot more in 2020.
Yeah, it's fascinating stuff, and I actually have a couple of questions in here about that, some of that stuff specifically. Before we do, just kind of tying the end of the rope here on the DeFi stuff. Something I've noticed as DeFi and open finance have really gained steam in 2019. While the potential for many of these early protocols are promising, most everything I've seen that has really taken off in the DeFi space uses over-collateralization today to manage risk within the protocol. Maker, for example, requires over-collateralization of about 150%, which is high when we compare those rates to something like, credit facilities and legacy finance. I guess my question is, how do you see collateralization rates dropping over time to better compete with traditional markets? Is that even a worthwhile pursuit to really map against competitive traditional markets? And I guess, will they ever drop? Do you think they will drop? And do you think over-collateralization will always be an important part for how these protocols trustlessly manage risk in the future?
So I definitely think they're going to drop. I think one of the big stories of 2019 was Compound, right? And so Compound has a more flexible structure in terms of these collateralization rates where they can change over time. And almost starting at zero, right? So at first you can't borrow anything against an asset, then maybe you can borrow something, but a relatively small percentage. And then as the thing becomes more liquid and grows, you can borrow more and more. But I think, stepping back, it's important to realize that there's a lot of collateralized lending in traditional markets. So if you think about mortgages and securities lending, I mean, DeFi can get huge, even if it just remains collateralized. As I said, I do think there's going to be more competition and collateralization rates are going to drop. But the really big thing would be if someday we can get to under collateralized or entirely non-secured lending as well. Now, that's going to look a little different than what we've got today in DeFi. So I think in that case, you're going to have identity and reputation be a part of it. And I think it might look different than the way it looks in traditional finance. So, projects that use attestation and can somehow generate reputation and ability and likelihood of repayment are going to be really important. Like, we're not going to be able to do it sort of anonymously or pseudonymously, right? Because in order to get an unsecured loan, you've got to know something about the characteristics of of the borrower, or if it was anonymous or pseudonymous, some of those characteristics would still have to be revealed in some way. So I think we're a little further out from that piece of it, but I think it's something to keep an eye on and something that's going to be really interesting to watch unfold.
Yeah, great answer. One area that we've already touched on a little bit that I'm excited to kind of dive a little bit deeper on. One area that's starting to really kind of heat up again is DAOs, so decentralized autonomous organizations. And we've previously spoken about this. There's a variety of reasons why DAOs might be interesting for a number of different projects. There's regulatory reasons for protocols and projects to look at DAOs to help kind of socialize control across the network, so no one independent party is in charge in the future. There's obviously potential efficiency and back office cost reductions that make DAOs interesting. There's new governance implications here that you've already started to touch on. I think it'd be great for our listeners to kind of hear why your team at Collaborative is excited about DAOs and why we're starting to hear so much about this space again. Maybe you can touch on your thinking around kind of decentralized governance, incentives around decision making, any research or writing you've done around our legacy markets and kind of the implications of governance and incentives there that could help shape some of how we think about DAOs and evolving governance in the future.
Sure. So governance is a big topic. Obviously, it's something people have been studying for decades, way before crypto, right? And one of the threats to governance or challenges, I should say, is entrenchment. Right. So the idea that you get a leadership team that is basically very difficult to displace. And so decentralized governance is interesting, and it obviously fits right in with the ethos of decentralization generally in this space. And in a sense, there are still challenges, though, just different challenges. So we've definitely seen some early traction from Decred, from Melon. Obviously, lots of these projects are using Aragon. And so I think, it's actually kind of quietly in the background. I feel like we're not hearing as much about DAOs as there is activity. But I think one of the big things is that, when you think about decentralized governance, one of the challenges is that you have to become informed in order to vote on these things, right? So say that there's votes all the time, like maybe there's votes weekly or at least monthly. And so for the individual token holder who just has a really small holding, we end up with what's called a free rider problem, which is that it doesn't make sense for them to expend the resources to become informed. And so they just sort of free ride on larger holders that are going to, have more economic exposure and something to lose, essentially. And so they will expend the resources to become informed and vote. And I think, one of the things we're going to see evolve as these systems rise up is the need for sort of proxy voting solutions, right? So if I'm a token holder and I have the ability to vote through a DAO, sort of decentralized governance, but maybe I don't want to become informed. Maybe I don't want to spend the time and resources to become informed on every single vote. It would be great if I could proxy my vote to someone else that I believe is going to vote in a way that's consistent with my values, right? Or with my interests. And then the idea is that at any time in the future, if I ever felt like there was another group that would do a better job in terms of the way they're voting, I could remove the proxy from the first organization and reallocate it or redelegate it to the second organization. And so that piece is really key, right? Because look at the way like the US government works. So we elect, whether it's a president or a congressperson, we elect them for some term, right? And maybe we think they're going to vote the way we want them to vote, but then they kind of can do whatever over that period. And then, of course, there's a re-election in the future. What would be great is if we could change that proxy at any time, right? So that way it sort of keeps everybody honest. It doesn't allow them to act in ways that are orthogonal to the decentralized members' interests. Or if they did, then the atomistic shareholder or token holder can reallocate their proxy. So there's obviously a lot of complexities to these systems. But I do think we're going to have to see evolution in the ease of voting, because I think requiring sort of every token holder to become informed about every vote is going to be a really big lift. And as we've seen, we don't have really high participation in a lot of these systems in terms of the votes. And so that's an area we're looking for continued evolution on in 2020.
Yeah. Steve, let's say the DAO concept is found in a few years or maybe 5-10 years to really bring enormous value to the way our financial markets operate over time. Is there a killer use case that you think that will have been because of? Why do you think, assuming that DAOs really do take off and really help shape and inform our markets in the future, what do you think will have been the reason?
I think it'll just be demand by the investors, right? And so, even relatively large institutions can, essentially be trapped by entrenched managers, right? So entrenched managers where maybe the board is captive or whatever else, don't necessarily. First of all, there's this whole issue of sort of short-termism versus long-term thinking, and you've seen long-term stock exchange rise up. So not directly related to crypto, but just something that's sort of tangential and really interesting, where they're trying to incentivize long-term thinking among managers. And I think basically the reason that we'll see decentralized governance, if we see it, is basically because the investors have demanded more control over the decisions of the entity.
Yeah, this is great, and I expect that this will be a hot topic of conversation here in 2020. Steve, wrapping up, what are some of your other predictions related to security tokens, open finance, DAOs over this next year, now that we have a greater information set about how this space is evolving and building out?
Yeah, so I think many of the things we've chatted about, we believe we'll see billions in issuances in terms of tokenized securities in 2020. It's if you just look at the aggregate volume of issuances, it's been growing really substantially every year. We expect to see that continue in 2020. We think automation and cost savings will drive a lot of the adoption in institutions. We think access and higher yield will drive retail adoption. Obviously, there's more work to do on the interfaces, just to make it very easy for people to use it, to make it easy for them to vote, to make it easy for them to do everything that we hope they will do in the crypto ecosystem. I think the other thing that we're really looking to in 2020 is increased regulatory clarity. Some of that will come through case law. For example, we're watching the Telegram case very closely in terms of determining sort of what is and isn't a security in terms of decentralized networks. And some of it will come through no action letters like we saw with Paxos. And so that's something we're excited to get resolution to, or at least increased resolution in 2020 as well.
Awesome. Steve, we're going to get you back on the podcast here in the next couple of months. In the meantime, where can people learn more about Collaborative Fund, the work you're doing over there, and how can they reach out to you if they'd like to learn more?
Yeah, so I think you can always reach me on Twitter. My direct messages are open. It's just at SB McKeon. And in terms of Collaborative Fund, just check out our website. So collaborativefund.com. We've got a blog on there where we post thoughts about crypto within our team, and then also lots of other. Morgan Housel is a fantastic writer, is providing a lot of content on that site as well, and it reports all of our investments and so on and so forth. So I'd say the website is the best place to learn more.
Yeah, I'll give a +1 to the Collab Fund blog. I'll also read anything by Morgan these days.
Yeah, he's amazing.
Yeah, awesome. Well, thanks for your time today, Steve.
Absolutely. Take care.
That's it for this week's episode of Security Token Stories. For more security token content, visit us online at securitytokenacademy.com and subscribe to our newsletter, The Security Token Edge, which lands in your mailbox each weekend. You can also keep up with the latest security token news by following us on Twitter, Telegram, YouTube, Facebook, and Medium. Before we go, a big thank you to Security Token Academy's Platinum and Gold corporate members who make this podcast possible. You can learn more about Security Token Academy's corporate members at securitytokenacademy.com. I'm Derek Edward Schloss. From all of us here at Security Token Academy, thanks for listening.
Security Token Academy does not provide investment or legal advice. We are not a registered broker-dealer or investment advisor. Opinions expressed in this podcast are the speaker's own and do not necessarily reflect the views of Security Token Academy. More information can be found on our website at securitytokenacademy.com.